So we've got the lovely Samantha this evening, who what she doesn't know about finances and isn't worth knowing. Like, she's just incredible. So I'm really grateful to have you come and have a chat. And
inviting me.
Yeah, that's all right. So yeah, I've popped our recorder on, making notes, and yeah, look forward to hearing what you have to say, Samantha.
Right. Well, I'm going to start off by apologising that I've come back to work late, and it turns out all the kids from the street come out and play outside, and I can actually hear all the chavvy ones shouting and swearing at each other. So if you do hear any like obscenities in the background, it's not my children. There is random street kids on the streets. I don't know if you can hear them. So oh well. So yeah, what I want to do first of all is just ask you a question, just to see kind of what businesses you've got. So the slides that I'm going to be showing you are just going to be based on sole traders, limited companies. I'm going to be going through payroll, VAT, just various different tips, tricks of the trade, that kind of thing. But I just wanted to know if you were sole traders or limited companies, and just kind of what entity that you've currently got set up. Does anyone raise a hand if they're a sole trader? Okay, so yeah, sole trader is fine. Now I will go through the limited side as well. I think it's definitely worthwhile knowing, especially if you are a sole trader, because there might be a point in time that you want to become a limited at some point. So it's obviously going to be helpful to understand both sides of things. So I'm going to share my screen. Okay. Give me a second to try and find you again. Okay. So I'll just tell you a little bit about myself then. So I'm Samantha Stokes from Cooper Accounting. So I'm Managing Director of Cooper Accounting based in Halifax. So I started actually in 2020 initially. I was a sole trader. We'd just gone into lockdown, so yeah, perfect time to start a business. And then officially we opened a limited company in 2021. Now we've grown to I think we've got 7 staff and 300 clients plus. So we're still growing. But yeah, it's been an exciting journey, really. So things that we're going to cover today then. So it's going to be the key financial and legal aspects of running a business. So we'll break down tax, bookkeeping, payroll, VAT, compliance, just a variety of different things, really. And it'd be more of an interactive format. What I don't want to do is just bore you. I do have a habit of just going on, and I could speak for hours and hours about accounting and tax, but I do appreciate that's probably boring or a little bit too much for some people to take in. So I thought what might be really useful is if I do each section, and then we break out just as how many questions. So any questions that you've got after each section, or even throughout, if there's any point that you either don't understand something, or if you just got a question about your own business or whatever, just feel free to ask, and we will do lots of time for questions. Okay, so we'll start off by talking about starting a business. Now, if you're both sole traders, you probably understand the very basics in terms of how you're going to get started in regards to registering for HMRC and your taxes and things like that. But obviously your first stage really of starting a business is trying to choose your structure. So the main 3 is that you could be a sole trader, a partnership, or a limited company. There's lots of different entities that you can choose from, but these are the main 3. So a sole trader is obviously just one person. Partnership would be more than one. And then the limited company is a separate entity to yourself as an individual. So the legal entities is obviously very different. Now there's lots of benefits to becoming a limited company, including like the different tax rates. Some people decide to be a limited company because it might have a certain reputation that it holds. It could be that you want to protect yourself or some assets within the business. So let's just say you have some property or certain assets. It could be an option to have them in a limited company, and that way, if something was to happen it could potentially be protected, or you're personally being protected. So if you was in an industry where you might get sued, for example, those are the kind of businesses that often go into limited companies, because if they was to be sued, you could potentially go after them personally. So there's lots of different reasons why you might go sole trader or partnership or a limited. So obviously you need to be registering with HMRC or Companies House if it's a limited company. I'm assuming that you've done that, but I'll talk from kind of the beginners if you haven't. So you need to register for self-assessment by the 5th of October, after the end of the tax year that you've been trading in. So if you started trading pre the 6th of April 2025, you would have until the 5th of October 2025 to register, and then that tax return would have to be filed by the 1st of January of 2026. Companies House, if you was to register a limited company, it's Companies House that you register with, and then they actually send a notification to HMRC. So you don't have to do a separate notification to HMRC. Just by incorporating the company is enough to register with HMRC. So setting up your bookkeeping system, this is something that needs to be considered quite early on, really. There's different ways that you can do your bookkeeping.
Sorry, are you meant to be showing your slides right now?
Sorry, can you not see my slides?
We can see the yeah. Well,
I might have selected the wrong. Let me stop sharing and share again.
I'm sorry.
Oh, I must have selected the wrong one. I do apologise. So,
Okay.
Can you see the slide that says starting a business?
Got it. Yeah.
And if I click the button, can you see the next thing that popped up? Fabulous. Don't know what I did wrong the first time, but this is a little bit better then. Okay, fab. So yeah, there's lots of different systems to setting up bookkeeping. So you could theoretically have bookkeeping as simple as just writing down in a book all your sales and all your expenses. Obviously, that can be a bit of a long-winded process if you have lots of income and expenses. It's not generally recommended, but for small businesses, it's still something that can be done. That one thing that you need to consider as a sole trader, I'm not sure what you all know about this, but there's something called Making Tax Digital coming in. So that's going to be starting from April 2026. We're actually recommending now to all our sole trader clients and also people who have property income to start thinking about this now. So actually, it's only going to start off applying to anyone who has £50,000 in sales or more, or rental income. So if in this year, actually I think it'd be based on last year. So if in the 24-25 tax year, if you have £50,000 in sales or property income, then with those people that will be eligible to be registering for Making Tax Digital coming April next year. So what will happen is you'll have to actually submit effectively 6 returns a year. So you'll be going from 1 to 6, so a big difference. And you'll also have to be applying for, using approved software. So it can't be, sometimes there'll be a bank that'll offer some accounting software with the bank. That doesn't mean that's going to be the right software to use with Making Tax Digital. There's only certain ones that are approved. So your main ones are going to be Xero, Sage, QuickBooks, FreeAgent. There are other ones, but those are your main ones to use. Actually, if you set up a bank with, I think it's NatWest or Metal, you can actually get FreeAgent for free with those bank accounts. So those are a good option. And I know they're going to be MTD approved as well. You'll have to prepare your bookkeeping every 3 months and then submit it within a month to HMRC. And the reason being is that they want to be able to see that these traders are submitting their accounts online more frequently, so then it doesn't get too much for them at the end of the year. But it also means that you can prepare for any potential tax liabilities as well. So doing that regularly is really just so HR can see they're effectively saying that they're trying to help. They're trying to make sure that people aren't overwhelmed with the tax liability at the end of the year and surprised. Whereas if they was submitting it throughout the year, then they might have been a little bit more clued up. But yeah, there's lots of things to consider. And actually, we don't really know all the ins and outs of it yet. It's something that's been going on a long time with HMRC, and they did put it back a couple of times. We don't think they're going to put it back again. But there are still some ways in which, in terms of how to submit, that not even the software companies are sure about at this point in time. So £50,000 or more, you definitely want to be getting on software now, because you can then get in the habit of preparing your bookkeeping every 3 months, and just sort of understanding about what you're going to have to do for MTD. If it's less than that, obviously using software is still a good idea, especially if you have a business bank account. So the great thing about using digital software is that you could have a business bank account. You would link up the bank account with the software, and then each day all your transactions from the bank will come through, and it just means that you can get these transactions easily without having to manually add them in. And what I often find is when people jot down their expenses, or maybe they just have a spreadsheet where they're adding in their income or their expenses, quite often they'll miss transactions. There'll be things that they hadn't remembered, or if it was an expense, they might be just little things like a car park expense or a bank fee, something like that they might not have thought of. So actually, by having your bank account linked, it means that every single transaction is going to be accounted for. So it's generally a good way of doing things. But yeah.
Can I just ask, the 50,000, is that all of your money in, or is it like profit after you've done deductions?
No, money in, yeah. So not profit, sales. So if you was rental income, then it would be just the rental income, and if you're a sole trader, then it would be your sales, yeah. And so it's going to be 50,000 from April, and then the year afterwards it's going to be dropped down to £30,000. And then I think that's the year it'll apply to partnerships with 50,000 as well. And I suppose we don't really know too far in advance. They might change their mind by then. But what we think is they'll probably just roll it out to everybody. They want everyone to be digital. So actually, the sooner that you can embrace it, the better, really, because it's not a bad thing. But it's definitely something that people need to get their head around.
Okay, thank you.
No problem. Okay.
Samantha, can I ask a question? Do you have any preference to which software?
So we personally are a Xero practice. So we love Xero. We use it all the time. There's always deals that you can get. So actually at the moment, if you get Xero, if you go on the website, they're doing a 90% discount for 6 months, I think. So the normal price is actually £33. It is quite expensive, but it does a lot for that software. There's different versions that you can get. So you'd get £33 one, you'd have your 90% off, so it'd be £3.30 if it's that 6 months. And when the subscription sort of ends and when you need to upgrade to the £33, you could then just reduce it down to a different package. There's cheaper ones. So if you're not VAT registered, then I think there's £7. If you are VAT registered, I think there's £16. So that's a really good one to use. But say Free Agent is brilliant because it's free if you're using Metal or NatWest as bank. QuickBooks, personally, I don't like. Obviously, you've got some people do like them. It's not for me. And then Sage is really good, but Sage has traditionally been more of an accountant-friendly software, whereas QuickBooks and Xero was more created for the user, for the business owner. So it might talk in a way that the business owner would understand, where Sage has often been a little bit more advanced, so it can sometimes be confusing if you don't have a great deal of bookkeeping experience.
Okay, thank you.
But yeah, there's lots of pros and cons to all of them, I'm sure. Okay, so yeah, and obviously you can just use a handy spreadsheet if you're not going to be part of MTD. One of the easiest things that you can do for bookkeeping, and this is a total hack if you do use a spreadsheet and not having software. If you they have a bank where you can download a CSV file. So I don't know if you know what that is, but if you go into your online banking, you could download your bank statements, and it usually comes up in the format of PDF, but there's usually a drop down to select CSV. The other one that doesn't work too friendly is Santander. All the other ones tend to work really well. So you would download, basically you're downloading your bank statements but into a spreadsheet format. Then what you can do quite easily, but it might be kind of complicated for me to explain. So if anybody has questions after this, feel free to contact me. I've got my email address at the end. But what you can do is you can highlight the whole area, and you can put it into description order. So rather than have everything in date order, if you put it in description order, that's easier, because let's just say it's me, so I've got transactions to myself, so Samantha Stokes, all the S's of the Samantha Stokes are always going to be together. Or if it was rent, or if it was EE, or whatever. So because if it's in alphabetical order, it's going to be a lot easier for you to be able to, you could put the first transaction in on line 1, and then if there was loads of transactions, you could literally just drag it down. So you can, there actually are ways of, depending what kind of system that you've got, or what kind of business that you've got, but you can potentially do bookkeeping in a very short space of time. It's not always good enough, but if you was starting out and you was a low enough turnover that you didn't need to track your debtors and your creditors and things like that, then it's definitely a nice, easy way of doing things. Okay, so just to go on to kind of what you need to keep then. So if you had any payroll records, you need to keep those for 3 years. You'll need to keep a copy of all your sales and obviously all your expenses. If you've got assets in the business, then you need to keep records of those. So let's just say you've purchased a vehicle or a laptop or any kind of machinery. These would need to be kept as well. So on the sales invoices, there are certain rules about what you have to include on a sales invoice. So if you are not VAT registered, then you would need, if it was on over £135 the invoice, then you would need to have more description on there. It would need to have your name and address, or your business name and your address. It would need to have, if it was VAT registered, you would need to have the rate of VAT and the VAT registration number. But what you also need to have is a date. You need to make sure there's a date on there, and of course the amount. So if you're ever looking for a receipt from somebody else, maybe they've just written something down, or it was just like a basic invoice, I mean, you know, at the very least, it needs to have the date, a description, the supplier name, and the amount on there. But yeah, with anything that's a low expense, you can have simplified invoices as well. So for example, if you was to go and get some car parking, you don't get a full invoice every time you get a car parking. It's just effectively the amount on there. And then you do need to keep these financial records for different amounts of time. So for a sole trader, it's actually 5 years from the end of the year. So that would be up to 6 years, and if a limited company, then it's 6 years from the end of the financial year, so up to 7 years. And then there is a legal obligation to keep these records as well, and also keeping them in a format that can be easily accessible if HMRC was to ask for any information, and they can actually fine up to £3,000 if they felt like the records were in a decent enough state, or if you weren't able to prove that you had any bookkeeping system in place. So
Could I ask a
yeah,
question?
questions at that point in time.
With the evidence of, like, say, a car parking ticket.
Yeah.
If you like take a picture on your phone and you have like just digital photocopies or scans of things, is that okay, or do you have to have physical things?
You don't need to have physical, no. And I think this is what HMRC are learning so much about how the way the world is going on. COVID actually taught us a lot, but things changed. The way that we hold records is very different. You don't need to keep paper receipts. You don't even need to get wet signatures for a lot of things anymore. Everything, you know, most things now are digital. So yes, you need to keep records, but effectively, if you had a software that you could take photographs of a receipt, and that was to upload it to your software, you could theoretically just throw that receipt away. We wouldn't recommend it just in case something happened. What I normally say to my clients is if they've got a software like that, is to take a picture of the receipts, and then probably just throw the receipt in some sort of bag, so you're not wasting your energy making them neat and tidy, because that's what the software is going to be about. But at least you're keeping them maybe in a box file is probably a good place to keep them, and then maybe don't do anything with them. If you do have if you're not having digital software and you were just doing things manually, then you probably just want to either keep them in a file that is maybe January to December or whatever your year is, and maybe there's a plastic wallet, and each receipt could go in each like plastic wallet perhaps. I mean, there's different ways. Some people have statements and then they'll get the receipts and they'll attach the receipts behind the bank statements. But really, the digital is probably the easier way to do things going forward, because that's just going to be the way you'll have to do things in the end. So I kind of feel like you've got to start as you go on. Has anyone got any more questions?
Can I just ask? So I've got two questions. The first one is like, maybe it's obvious, but what happens if you lose a receipt? So, like if it's just the odd one, but like I have done this, so we take pictures and then we store them on a hard drive and we back them up, and I do shred them, but maybe I'll start keeping them. But just because I have so many, but sometimes I've matched it up to my business account and then realized that I didn't, particularly for somewhere say like Tesco, where you have to click yes, I want a receipt, and if I've walked out and I haven't done that, but it's on my bank, my business account, because it was for business, what do I do? Do I not include that on my expenses if I don't have the receipt?
So if it was VAT registered, it can cause an issue, because you can only claim VAT if you have the VAT invoice. If you're not VAT registered, then yeah, technically speaking, you need the receipt. But if we're talking small amount, HMRC would never look, they're not really bothered about these tiny receipts. If you're talking about large amounts and there's a reason why HMRC could question that, then I definitely want to get that backup receipt. But generally speaking, if you had a large expense, you could probably still ask those suppliers for those invoices if you needed them. For the small ones, no, I would still, if you know that it definitely was a business expense, I personally would still put it through. It's just a tricky one, because there's no way of proving it. So especially if it's like Tesco's, who knows what you bought from Tesco's? You could have bought a pack of fags or some stationery. You don't know. But if it's tiny and it's the odd one, I would, if you know that it really was, I definitely would include it in my accounts.
Thank you. And my other question is about, so all of my receipts are generally quite small, but I buy a lot of resources. So I work with children, like from charity shops, so like books, and like I get everything from that. Even things which might look odd, but I'll use it in some way. But the receipts are normally quite general. Do I need to prove that? And the same with like my local shop. It's gone now, but I have like 1 million receipts from Well Worth It, and they never have an item next to it, but it's mostly sell stationery and crafts.
Fine. So again, the tiny, HMRC are never going to question it, but HMRC are also aware that there's lots of suppliers and businesses out there that don't issue proper invoices, and that's not your fault. It doesn't mean that you can't claim it. And ultimately, if you have a business expense, it should be included. So if I was to purchase a laptop for my business and I bought it on Facebook Marketplace and I bought it off just a random person, of course they're not going to give me a receipt, are they? But it doesn't mean that I shouldn't be able to claim that expense, because it's still something that I have purchased for my business. So as long as you can evidence it in some way, then you're really just protecting yourself. But again, small amounts, HMRC would just, it's not worth their time. The hourly rate is higher than the amount that you're looking for, so they just wouldn't even look into it.
So with something Vinted, because I've genuinely done that, where I've bought like teacher bundles or books, but I haven't put them as my expenses, but it is
have a receipt book. So what some people do is just go to the pound shop, buy a receipt book, and if there's ever times where you get something without a receipt, just write it up. And it's no proof, because anyone could have done that. But you could have created your own sales invoices at the time for an expense that you had. So in a way, they don't really prove too much unless it's a bigger business and if it was VAT registered. So it's not something that you need to worry about too much. Obviously, you do want to get the receipts where you can, because again, HMRC would see that as bad bookkeeping if you didn't have those. But if you didn't have the receipts or very good receipts from time to time, yeah, absolutely fine. Just make sure you know that it was a business expense, and it's more to do with intention. If you know that really was a business expense, then it's your word against HMRC's, but which they can't prove. So yeah, definitely fine.
That's great to know. Thank you.
No problem. Any more questions? I'll move on to the next section. Okay, so sole traders and partnerships. So as we said, I'm sure you all know what sole traders are. Partnerships, if there was say 2 sole traders together, joining together, if there were a partnership, you would actually have to file a self-assessment tax return for each partner, and then you would have to have the partnership registered as a separate entity as well, and then that partnership would also have a self-assessment tax return. So if there was 2 partners, there would actually be 3 returns. And obviously for sole traders, there is just the 1. So of course, you've got the self-assessment tax return that's due every year by the 31st of January, unless of course it's going to be as of next year, if it's over 50,000 making tax digital, then it's going to be due every 3 months, and then you'll have these 2 assessments at the end that you have to file as well. So apologies if there's anybody Scottish here, because these are actually rates based, not in Scotland, but if you are self-employed and you have to pay income tax, then it would be standard rate 20%, higher rate 40%, and then additional rate is 45%, and that's based on all your earnings. It's not just your profit. Well, on your income tax. Of course, you can claim your allowable expenses, and I do get asked this a lot about what kind of expenses that I can claim to reduce that taxable profit. And ultimately, the answer is anything that is wholly, exclusively, and necessarily for the purposes of business. So that is the actual definition of what is an allowable expense. So quite often people ask, "Oh, you know, I've been on holiday, and then I actually went to a cafe and I did some work and I bought a drink, and you know, because I was on holiday was allowed," that kind of example. So it's all about intention. So it doesn't matter the circumstances of how much you've spent or where it was. Whenever you purchase something, if your intention at that point in time was for that expense to be for your business, and it's wholly, exclusively, and necessarily for the purpose of business, then it's 100% an allowable expense. The times that it's not an allowable expense, it could be if it's not in the right name. So it might be that for example, if it was a limited company, it was in a sole trade name, you've got to be kind of careful on that side of things. If who owns the assets. So again, it's more on the limited company side, but people kind of struggle with knowing when to claim for motor vehicle expenses. But if you're a sole trader and you have a vehicle and that's been introduced into the account, then all of the expenses relating to that vehicle then would be able to be claimed. Things that you couldn't claim for would be any personal element. So they call this dual purpose. So if you had an expense that actually served a personal purpose, then that might not be allowable. But then there's often times that this kind of thing goes to court as well with the HMRC, especially now with like social media influencers and models and things, because these arguments of, well, if somebody was to have their hair done, is that an allowable expense if actually they've done it for business, but it also serves potentially a personal benefit too. And so it's really more down to the intention, but depending obviously what kind of businesses you got, the general things that you're going to be able to claim, if you're working from home, you would be able to claim a flat rate expense of £312, well, up to £312, based on the flat rate calculation method, and this is to cover your gas, electricity, and water, and your rent, kind of thing. But there's also different ways of working out. So if you do work from home, you don't actually have to calculate it that way. If you felt like your costs were more than £312, you could argue that one room in your house is bigger than the average room. So you could divide all your bills together and divide it by the space that you're using. There's not really a set way of working it out, as long as you come up with a reasonable calculation. HMRC just want to make sure that you're just claiming the business element and that there's no personal element, so that there's no dual purpose. So as long as you've got a calculation to show the proportion of the area that you are using is for business, and then that's usually fine. And of course, like travel, marketing, and professional fees. There's various different types of expenses that you can claim. So travel can be a sticking point for some people. A kind of general guidance on this. So like say it is subsistence. If I had a staff member and the staff member said, I'm going out for dinner to Greg's, can I have a fiver? I'd say no. They could just bring their own food to work, couldn't they? Or they could spend, use their own money to go to the shop. But if I was to send a staff member to a completely different place for the day, maybe they're going on a training course, or just something completely different to their normal day-to-day activity, then it could make sense that I might pay for their travel and their food, perhaps when they're away. So HMRC, I guess, would take the same viewpoint that if you're close to home and you're hungry and you're just going to McDonald's to just have something to eat, that probably isn't an allowable expense, because the purpose at that point in time isn't to help the business, it was to help yourself because you're hungry. But actually, if you was working away and it was not what, it was completely out of the normal activity of work, and you was further away from home than normal, then it would be completely acceptable to eat food on the way. And you don't have to be limited as to where you go as well. You don't have to be buying something from Greg's when you could have spent a little bit more from a nicer restaurant. That's completely your choice. But a lot of it's common sense as well. Some people try to put expenses through that have got like children's meals on there, or it'll say covers and the number of, how many people are actually sat at the table. That's kind of a bit of a giveaway. So what you've got to think is it's common sense, really. HMRC are people, they understand business, and they also understand how people try and put things through their expenses. So I think, and again, like with mileage, if you're going to put like a mileage claim through, if you're working from one place of work, like a shop, that you never go anywhere else, then it would be probably unrealistic to claim 10,000 miles every year. If you as a sales rep, however, that would make more sense. So ultimately, the kind of expenses that you're going to be claiming, HMRC are probably only going to question them if they seem that they don't seem to fit with the kind of business that you got. Doesn't mean that you can't have them. If you genuinely think they really were business expenses, then you just got to prove it. But yeah, is anybody else about kind of what expenses that you can claim, because it's usually quite a common thing that people have questions on.
Can I just ask about the home? So I knew about the £312 if you're working from home. What about if both people in your household are sole traders? Is it just one set that you do because you're both in the home? Does that make sense, or do you both put that through your own expenses?
Per person. So you could have two people in that house claiming £312 each.
Okay, and then the other question I had about when you were mentioning mileage,
yeah.
Do you have to keep like detailed records? Like I write down where I go. Do I need to do that in as much detail as I do?
No. So ultimately, there's no way of proving it. For starters, HMRC of course want you to keep a record of it. But there's no way of knowing whether that's accurate or not. So you could go to a lot of effort and put a lot of detail, and that's absolutely fine, and it might be good for you to be able to do that. But even if you had something like a notebook in your car where when you was going on a business journey, you just looked at the mileage and you just jotted down the date, the start mileage, at the end of the journey, the end mileage. So I get a lot of people doing that, and then maybe they'll type that into a spreadsheet, and the spreadsheet will just work out how many that they've actually used. where you've gone, HMRC is not really interested. They just want to know that you've got some sort of proof for it. But if you want to keep a log into that detail, that's completely up to you. There's no reason why you can't do that.
Okay, thank you.
Anybody else?
Samantha,
Yeah.
okay, I'm a bit more complicated. I
Right.
have a business which I've run for several years, for a lot of years as a hairdresser. So I do my accounts on Excel spreadsheet. I have all the same clients, so it's nice and easy with regards to my travel and everything. I'm going to the same places every month, and so I've got that kind of sussed and down to a fine art. My problem is starting my coaching business, which I'm starting. I'm not really sure at what point do I start. I've acknowledged that that's up and running because my website's live and everything. I haven't earned any money from that yet, but I have had a lot of expenses going out for that business to build it and set it up. It's knowing how much of that I can put through. Is it,
The
does
rule.
it go against my other business, or does it go, yeah, it's just a bit complicated for me at the moment.
Fine. So whatever the expense was for is where the expense should go. So of course,
Okay.
if you had an expense that was for the other business, then it's for the other business. But if the expense genuinely was for the new business, even if it hadn't started and it was just you doing some research and you literally any expense, it used to be that you could go back 7 years, because quite often businesses need to get that stage where they need to put a lot of expenses in and work preparation in before the business actually starts. So and HMRC are completely fine with that as long as you've got your own way of tracking it, because obviously a lot of it might be cash expensive, might be from your personal account, because if you haven't properly started you might not have that business account at that point in time, but as long as you can record those expenses, yeah, I would definitely put them through with the new business.
Okay, right. Yeah,
That's
because
your question.
what I did last year, when I submitted my last accounts, I just wrote off everything that had come before that, because I left it too late to get advice and everything. But I wasn't sure, am I allowed to go back a couple of years?
So what you've got to think about is, if you had put it through at the time compared to if you were to put it through now, would your tax have been different? So if the tax rate was different in a year you're talking about, that might have an effect.
I don't think it would have been.
If the tax was exactly the same, then there's no
Yeah.
difference. So yes, theoretically, the correct answer is you would refile the tax return from the year that it should have gone into. But depends how much you're talking. I think if you're talking a large amount, you probably have to refile the actual correct year. If it's a smallish amount, I'd possibly still bring it forward as long as you can prove it, because it really was an expense. And even if HMRC did say, let's put you back in the situation that you should have been in had you have done it right the first time round, it would have been exactly the same. So it seems kind of pointless just refiling the return. But large amounts, I would definitely, because they might question if it was a larger amount.
Okay.
Okay.
Thank you so much. Thank you.
Also, I'm conscious I've waffled a time, so I've got loads of different extra things I want to talk about. So, PAYE, VAT, and limited companies are the sort of other areas. But is there anything that's more that you actually want me to talk about? So, is there anything that you want to know about PAYE? Has anybody got any staff or thinking about getting any employees? And what about VAT? Is this something that you feel like you might be nearing the VAT threshold, or want to understand that a little bit more? I can talk a little bit more about the sole trade, and then maybe about what points you can go into limited company, because I feel like that might be something that you would probably find useful. Okay, that's fine. Then I know which ones I can skip on, and we can go into more detail on the others. Okay. So yeah, allowable expenses wholly, exclusively, and necessarily for the purpose of business is purely intention. If it was a business expense, it was a business expense, and it's kind of as simple as that. So there are penalties for not keeping the proper record. So like I said, you can get fined up to £3,000, and you need to keep it as a sole trader for up to 5 years from the end of the accounting year. And there's also penalties if you miss deadlines as well. So if you don't file a self-assessment tax return by the 31st of January, January, then you would have an instant £100 fine, and then you would also get fined up to 3 months. Oh God, I've forgotten now. Actually, I think it's £10 a day, up to £900. But in the end, if you hadn't filed a tax return for a year, the fees can be a few £1,000s. So it's definitely worth making sure that you file a tax return on time, even if you had provisional figures. So I've had times where people have been in a bit of a panic, 31st of January, and they say, I'm really, just not going to have time to be able to file everything on time. I've still got some information that I don't 100% know. It would actually be better in those circumstances just to file the tax return and click the button provisional figures, and at least to file it and then refile it properly when you actually know the right information, because not filing it on time is the worst thing that you can do. And also there's obviously a lot of stress with that, and I feel like a lot of people that I've spoken to who have issues and big debts with HMRC are often because they've been late, and people sort of tend to bury their head in the sand. So try not to do that, but easier than done, of course, because it can get a little bit overwhelming. One thing that you do need to understand actually is something to do with payments on accounts. I'm not sure what you know about this. So in your first year, if your tax bill is more than £1,000, you're actually going to have to end up paying double. So if you have a liability of £1,000, what they want you to do is pay £1,000, but they also want you to pay £500 by the 31st of July, as well as the initial £1,000 by the 31st of January. And then you've got to pay the other £500 by the January afterwards. What they're trying to do is make sure that you've already paid your liability by the time it gets to the end of the year. And then quite often, things that HMRC do is all about trying to put the money in their pocket as quick as possible. And they recognise that some people don't file their self-assessment tax returns. So by making you pay early, it means that if one tax return was to be missed or late, it's in their bank account quicker. So yeah, if it's a tax liability of under £1,000, it's absolutely fine. But yeah, if it's more than £1,000, then you just need to be mindful that that first year will become more expensive, because you're going to have to keep a little bit more aside. Going forward from that, if you're always over £1,000, it won't really affect you, because the year afterwards, the tax liability will be calculated, and then whether or not you'd paid over or under on your payments account, that new figure will just be adjusted. So it's kind of like it'll be carried forward, and then it just means in that final year of trading, you can then claim the rest of that money back. Or if there was any point in time that you dropped to below £1,000, then you'd claim that money back at that point as well. Okay, so becoming a limited company then. So the rule of thumb to start a limited company used to be around £30,000 to £40,000 in profit. Now the rates have changed a little bit. It is tricky because it's kind of a case by case situation. There's no kind of hard and fast rule about when is the best time. But there's definitely still a tax advantages of being a limited company. Especially if you are a higher rate taxpayer, or if you maybe have child benefit, because there's certain things that you do to kind of reduce your income and take it out in different ways. There's certainly advantages of being a limited company over a sole trader. For example, you've got the limited liabilities, so it's protecting your personal assets, and of course it's the tax efficiency, like I said, with the personal tax. So one thing that you do need to understand, and people often get confused with this, is you paid two different taxes. So if you had a limited company, the company would pay corporation tax, and then the profit that is left after tax can be drawn down by the directors, and that would then either be taken down as salary if it was declared through PAYE, or it would be declared as dividend income. So what some people get confused about it. They feel like they're getting taxed twice, because corporation tax and then the personal tax as well, and you're not. And if I had more time, I could show you all the ins and outs of how that works, but it generally is more tax efficient to do it in this way, because there are different rates, and of course you're only getting the personal tax rates on the amounts that you're drawing down from the company. Of course, there's legal responsibilities with having a limited company as well. So if you had a limited company, you've got to do your annual accounts every year, and they need to be filed to Companies House, but they also need to be filed along with a corporation tax return to HMRC every year. And then if there is any dividends, you would declare that on your self-assessment tax return. You'd also have to file something called a confirmation statement. This is effectively a statement that you're giving Companies House to confirm who is in charge of the company. So they call it a PSC. So whoever is in charge of running that company, who is the director, who are the shareholders, the addresses, that kind of thing. One thing that you can consider about when you start a limited company is the share structure. Quite often, this is where people get this wrong and fail to understand. When there's more than one director, I'll just give you an example. So husband and wife have a limited company together and they have 50-50, but let's just say wife has another job and the husband doesn't. Maybe they're just taking income through the limited company. If, say, the company was to take profits of £100,000 after tax, and the husband wanted to take £50,000 out of the business for himself, because his wife would also have the 50%, she would have to take that 50,000 too. But if she'd already had income elsewhere through employment, then actually, let's just say her income was £30,000 or £40,000, as a standard rate taxpayer, she would be forced to go into the higher rate tax because her husband's taking that 50,000. So this is one example of why having alphabet shares is a better suggestion, because here what you would do is you would amend the share structure. So it might be that the wife only takes shares after the husband has taken a certain salary. So they can have A shares and B shares. So you're just setting it up. Obviously can get a little bit complicated, but it just means that there's more flexibility. So if you're sole director, and then there's no reason why you would need to be having complicated share structures, but where there's different people with shares with different income levels, lots of different things going on in their lives, then it's definitely worth considering alphabet shares. The general way as well with a limited company is that you would set yourself up as an employee. The general amount to pay yourself at the moment is £12,570. However, that is again individual. It can change depending on your circumstances, but that's the most common, most tax efficient amount to have. However, if you are a higher rate taxpayer and the company was actually earning say £100,000 or £200,000, then it can actually be more tax efficient to have a high salary and the lower dividends rather than the low salary and high dividends. So yeah, the general rule of thumb, if you're a standard rate taxpayer, then go with your low salary, high dividends, or the rest in dividends. And then if you're a higher rate taxpayer, then you probably want to increase the salary instead. One of the benefits as well of the limited company is that you can actually have directors' pensions. That's a completely allowable expense. So £100,000 in profit, and you had an available cash flow, and you wanted to put in the maximum actually each year is £60,000. So for argument's sake, if you did put in that £60,000 into a pension scheme, that would act as 100% as allowable expense, as long as you were a main active person within that business. So you would be able to reduce the profits and reduce the corporation tax. So quite often a good one for business owners. And then, of course, is penalties with late filings. So if you was to file a company's house return late, that is, I think it's £150 from the first lateness, and then it keeps increasing, I think maybe to 350, 700, and it keeps going. So of course, being late again is not a great idea. If you ever a time that something was becoming late, it's actually just better just to call them up and say, it's going to be late, is there anything I can do? If it's company's house, you can actually get an extension for a month. You don't even need to really give a reason. They'll just pretty much give it to you, and there's no extra fee for that. So I'll skip on payroll, and the next thing is going to be on VAT. So is there any questions at this point? I'm sort of conscious of time. Okay, so how about just carry on? I'll tell you a little bit of the basics on PAYE and VAT. And of course, if anyone's got any questions, just interrupt. Okay, so payroll. If you have staff, you've got to be very careful here. So anybody who is treated like an employee, you just need to make sure that whether or not they have something called badges of trade. Quite often, what we'll see is business owners don't want to go through the headache of employing staff. So what they'll do is they'll just call everybody a subcontractor. And that could be true. They might be a subcontractor. But if you're treating them like an employee, or you had an employee already and you had a subcontractor and you were treating them like the same as the other person, you just got to be very careful. You've got to question whether this person has badges of trade. If that person is, in fact, self-employed, do they have other work of that? You know, do they just work for you, or are they working for other places? Who decides the work? Whose tools are they using? And these are kind of things that HMRC would question. And so, something that you've got to be very careful that is more to do with the rights thing. So, if you do have an individual who is an employee, even if you haven't called them an employee, they might still be one and have rights such as holiday pay, redundancy pay, all sorts of different things. So you've just got to be careful about that treatment. If you do register, you need to register up to 28 days before you make the first payment, and you need to register. You need to make payroll submissions no later than the date that you pay employees. So you couldn't pay an employee weekly and just submit your payroll monthly, for example. You would pay. You would deduct the PAYE and national insurance from the employee and then pay that over to HMRC on their behalf. And then you would also potentially have employers' national insurance as well to pay over. However, if you are a small employer, then chances are you would probably get something called employment allowance, which is where you would get relief for the employment for the national insurance. There's also HR considerations as well. Of course, if you do have an employee, that you need to make sure that they've got the necessary employment contracts and that you're paying holiday pay. The basic way of working that out, if they were on casual hours or irregular hours, is 12.07% of the total hours that they've worked. However, that even can get a little bit quite tricky. So if you're in doubt, then obviously you can speak to either ACAS, which is a free organisation to help employees and employers, or obviously there's HR companies out there too that can help. And then, of course, you've got to potentially enrol them into a pension scheme. So this happens from just having one employee. If you have one employee who is eligible, so I think the rules are if they're over 22 and under 65 and earning, I think, £833 a month, then you would have to enrol them into a pension scheme. And you're not allowed to ask them whether or not they want to be in it. They're allowed to opt out, but legally you're not allowed to ask them. You've just got to enrol them whether they like it or not. And then if they don't want to be in it, they've actually got to ask to be removed. And of course, you can pay weekly or monthly, it doesn't matter really, but there would be penalties for not filing on time. So if you've told HMRC that you're going to pay a member on the 30th of April, but you don't submit it by the 30th of April because you've changed your mind, you would get £100 fine. So if anything does change, you need to tell HMRC and make sure that they understand. Okay, so VAT registration. So this is something you do need to be mindful of. So the VAT registration is £90,000, but it's with any 12-month period. So some people get a bit too complacent with this because they might think, oh, well, actually, I'm only taking £5,000 a month, so therefore, over the year, that's a lot less than the 90,000. But let's just say you had a one-off order in 1 month that was very high, and then 12 months later, you had another high order. Those two individual invoices from the very beginning and the very end, depending on the dates of those invoices, could be the thing that kicks it over, because it's 90,000 in any 12-month period. And what a lot of businesses get wrong is that they think that this threshold starts again just because their year end started again, and it doesn't. There's also different schemes available. So there's a standard rate VAT scheme, and there's a flat rate scheme, which is where you would charge your customers usually the 20% rate of VAT, but you would only pay over an approved amount to HMRC, and HMRC have a list on their website of the different industries and what percentage that would look like, and then a cash scheme, which is VAT based on the date of payment rather than the date of the invoices. So there's obviously pros and cons of being VAT registered. So you've got the ability to reclaim the VAT on purchases, even if you are not anywhere near the 90,000, depending on who you're selling to. So if you're selling to VAT registered businesses, then actually it might be a good idea to be VAT registered, because you would charge them 20% VAT, but they would be able to reclaim that VAT on their own VAT return. So it's not going to affect them, you being more expensive in that sense. But it also means that you're going to be able to reclaim the VAT on any of the purchases that you have, and you can actually claim back pre-VAT registration claims as well. So you can actually go back up to 4 years for goods and 6 months for services, as long as you still had those within the business. So if you bought a laptop 3 years ago and then you go VAT registered, you would still be able to claim the VAT on that laptop, assuming that you still had it in your possession at the point that you go VAT registered. Okay, so is there any more questions relating to PAYE or VAT, or any questions actually? So I think that's at the end of my slides, pretty much. Probably more just sort of conscious of time. So if you've got any questions, that's kind of it from me. I will.
Samantha, can I ask you another quick question? Yeah, thank you for letting us know about the VAT for the 90,000 over any 12-month period. I didn't know that, and I would have assumed that it was from your year end to your year end. So that's been very valuable, even hearing that little bit. As a sole trader, would you recommend having a salary or paying yourself a salary? No.
No.
Whatever you make profit is yours.
Exactly that. Yeah, you can't have a salary. Yeah, so you wouldn't. You can have employees, but yourself can't be an employee.
Okay.
Partnership or as a sole trade. Limited company you would, sole trade not.
Okay. Thank you very much.
Sorry, I had my mic on. Can I just ask then, as a sole trader with a business account, and because your profit is what you pay yourself, is it normal and okay for your money just to keep going into your bank account? Would you do it? Would it be expected that you do it all in one go, or it looks really messy?
Doesn't matter, because what you pay yourself isn't income or expenses, so it has no relevance to your accounting at all in regards to tax.
Okay, thank you. So in terms of like my paperwork and things like that, I don't need to write when I take money out. It's just, I literally just need my money in, my expenses, and that's it.
If you were doing a basic tax return, yes. If you was doing a full set of accounts where you wanted to have a look at your profit and loss and your balance sheet and various things, these are things that you don't have to do as a sole trader, but some companies, some businesses may choose to have a full set account. Then yes, you would look at the amount of money that's been going, that you've drawn out, but it's not something that's necessary. It doesn't take any relevance over the tax that you're going to pay. So no, I wouldn't overthink it. If you have a business account, I would still transact every single transaction would be accounted for. You would just say drawings for everything that's gone to you, and then if it was income or expenses, you just say what those particular items were.
So I wouldn't need to put it on my spreadsheet though, if
Depends on how you're doing your accounts. No. So if you were purely just wanting to do your self-assessment tax return and look at your income and your expenses, no, you don't need to put it on your spreadsheet. If you was doing your accounting in a different way, where you was connecting your bank statements, like the example I gave where you could download your bank statement, you would probably put a description next to every single line. You're just effectively not going to count it in the end, but you would still account for it. It's just not going to be in the calculation of your tax.
Yeah, okay, thank you.
No worries. So I will share actually in a minute, if this is okay, just my contact details. So if anybody does actually think of any more questions, so I'll share that, so then you've got my number and my email address. As part of this as well, I am happy to do like a free review for you. So if you want to, like, let's just say you've got a spreadsheet and you just want me to have a look over, or you want some advice, or just any basic questions, I'm more than happy just to answer the questions that you've got, or just give you some feedback on the way that you're doing your bookkeeping at the moment. So I'm just going to share that. And you will see. I'll come up in a minute. Okay, fine. So if you do want to take my contact details, then feel free.
And while everybody's taking your details, Samantha, thank you. That was so informative, like crazily informative. It was brilliant. Thank you.
I found it useful, and I'm glad that there was no swearing in the background as well. I'm surprised about that. They must have got in now. They were quite loud at the start, but yeah, honestly, any questions, I really don't mind. So I hope you found some information useful at least.
Loads, I suspect.
Okay, so does anybody need any more time, or shall I stop sharing? I will stop sharing now. Okay, fab. So yeah, no problem at all.
Brilliant. Oh, thank you. Yeah, Claire's just put a note. I don't know if you saw it. Saying, thank you so much. Really well explained. Jane, thank you so much. It's been so helpful. So.
Yeah, thank you.
No problem. No problem. So yeah, pleasure to meet you all. Yeah, so enjoy the rest of your evening.
Thank you so much. And you.
Lovely to meet you. Bye.
Bye. Bye.
Bye, everyone.
Bye, Jane. Bye.
How did that go?
Brilliant. Let me just get rid of my fab.